Welcome to the Dividend Talk podcast, episode 142, quarter 123 portfolio review. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJI. How are you, buddy?
Really good actually, because this week I was so busy at work and I was so annoyed with everything that was going on. It's really sometimes it's a mess. It's high season for me, but then you see the dividends coming in. Oh, the Shell dividend! It's my biggest position, my biggest contributor. It was so nice, and it really gives you this freedom feeling, right? And then the Unilever dividend as well, which is also quite significant. So it feels so good just seeing these dividends come in. I love it. I really love it.
Yeah, it's been. I'm the same at work. I was supposed to travel with work this week, and it was so crazy back in the factory that got cancelled. All the flights, everything. That money was wasted. It was that busy. But it's as you said, March is a surprisingly busy month in terms of dividends, and we'll get into that. We'll get into how we did over this quarter. But first of all, what's been in the news this week?
Well, quite a lot actually, but maybe the first one that I would like to highlight is one of my favorite stocks that I don't own. Wolters Kluwer got a credit rating upgrade from Moody's, and they had a Baa1, and now they are going into the premium grade of A3. So I just want to call it out because I've been following this company for some time. It's always a bit too expensive for me. But maybe I just need to pull the trigger one time just as an entry position because I just love this stock so much. I really love them, and I think it's a really good business, very solid. They have a really nice combination of continuous dividends and buybacks. So I'm a big fan of this stock. And I also sometimes I hear people talking about it like, we're doing a deal with Wolters Kluwer, their databases and such, or an integration with them. And they're just on fire. And then the continuous buybacks on top of that, they have such a good capital allocation strategy, organic growth of 6 to 7% in revenue. I mean, I'm surprised that it took them so long to get this credit rating. But yeah, I really need to get the stock one day.
Interesting. I have them inside my Dutch trading 212 pie that I robbed off your blog post one time. it's been doing pretty well. So I do own a small piece of this company, but as you said, boring company, but one that's doing really, really well. And look, it's interesting. I think Moody's is always a good place to read about companies. Don't take the word as gospel, but they do give you some good insights. And it's very telling that in the current economic cycle that we're in, that Moody's think that they have such resiliency to that to increase that. So it's a good sign. Yeah.
Well, actually, Moody's is probably one of the only groups of analysts that I actually take relatively serious because they have a good system behind it, and they always write down like what it will take them to upgrade and what it will take them to downgrade. They're not the accountants, so they are not like KPMG looking at like that, but there's always very useful information in it, and you can see that they really do their due diligence compared to the regular Wall Street analyst that is just pump and dump, what it often feels.
Exactly. They have less to gain from their, I think, less to gain from their reports than your average Wall Street.
Although I will never forget the Big Short movie, where they went to the credit rating agency and they said like, hey, kind of they pay us. So what do you think? With the banks at the time.
Yeah, look, you can't rely on them 100%, but I think it's a really good place to start. Even
Good
before
source of
yeah,
information.
yeah,
Yeah.
exactly. Johnson, we've spoke about, and I think it is official that the Supreme Court dismissed their. I think they wanted to delay the last ruling when the bankruptcy. They wanted to file for that. So I think they're going to have to face this now. They're going to have to hit it head on and just deal with it. It does not look like they can bring it to bankruptcy. But we don't know how much it's going to cost, but it looks like it's manageable for them.
Yeah. And what are they going to do now with the mentees from Bayer that came all across the pond there to learn from the litigation and legal officers?
But Boya came over and they've lost even more money on plane tickets and hotels because they're
Yeah.
gone back home without any more knowledge. But
And even so, Bayer comes over and the virus spreads to Johnson & Johnson. Now Johnson & Johnson is also screwed. Oh, boy.
maybe Johnson & Johnson took advice from Boyer and they just screwed themselves over. But it's
Yeah.
I think at this stage, I think they just have to face up to the fact that they're going to have to deal with this litigation. They can't spin off. They can't file for bankruptcy. So it looks like they're going to have to just suck it up and see what happens.
Well, you know, if you hear how many people are addicted sometimes to all this stuff, right, to the opioid, I'm not surprised that there's some litigation there. But okay, that's for another time. And last thing, then a little bit is like, you know, I'm the classic bag holder of Alibaba with an average price of 150 or 140. I forgot even. It's trading around 100 now because the price jumped 14% after the news that they have decided to follow kind of the alphabet model. So they are creating from their company 6 business units that effectively will operate independently. They can even IPO and raise capital if needed. The 6 business units will be cloud intelligence, Taobao, Tmall commerce, local service, and blah 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 blah. Generally, I like it because it makes it a bit more transparent in this company. It's a hard to analyze company generally. Honestly, I still think it's heavily overvalued, but of course, the Chinese government is like the invisible hand above the share price. But it's one of those kind of failures of my, my 10% of the portfolio that I like for growth stocks. So, well, let's see where it goes and where it stands by the end of the year. Then I'll make up the account and the balance sheet because that's been 3 years.
Yeah, you're still holding on to it. If it touches break even, would you be tempted to sell before the end of the year?
No, not really. No. Okay. I really want to try to do my best with this one. It's also a bit for me learning money.
Yeah, I mean, I've heard the news, but I haven't looked into these 6 different business clusters. Some of them don't even make sense. I don't know what a Taobao, Tmall commerce group is. Like I don't know, but it could be a good thing. It could be a bad thing, but time will tell. But it's it's interesting for people holding this now. 3 years without seeing a return on a growth stock is hard to swallow.
What was funny that actually a few days before it was heavily in the news that Jack Ma, the former the founder of the company, was somewhere spotted in Shanghai on a university. And then I feel like, this hits the news like, oh, wait, he's still alive.
Well timed. Yeah, he'll go missing now for another 6 months or something.
Says enough. Yeah.
Okay, enough doom and gloom, I suppose. Let's talk about our portfolios. And we'll start with you. How did you do this quarter in March, first of all, and this quarter overall?
I would say I did decently. I was expecting maybe a little bit better when I was running the numbers. But I noticed that the BHP Billiton dividend was not paid out yet to me on my account. Should have been paid yesterday. Still waiting on it for it on Interactive Brokers. But look, hey, the most important metric, my quarterly net dividend income. So what hit my cash account went up by 19% compared to last year. Specifically in February, it did well. It was 30% more. In March, it was about 4% less compared to last year because last year BHP gave me such a huge, big dividend that is not being accounted for, and they even didn't get a small dividend this quarter. So, but still, let's say almost flat in March. So 90% on average up is a really good result. My portfolio yield is now 3.7%. It was around 3.8, mainly because in the last few days my portfolio value went quite a bit up, which is developing well. And the portfolio yield doesn't really matter as such because I'm buying some really interesting stocks at the moment. So what I bought in this quarter, in the beginning of the quarter, I bought some TROW price group. I bought 2 times Johnson & Johnson, one time around $160 and the other time around $150. I bought 2 times Nationale Nederlanden Group, NN Group, one time around €40 and the other time around €37. I didn't buy yet at these price levels because I have this rule to not buy too aggressively at once. But maybe in the upcoming quarter, I will round up my position size there. I also bought some shares in Defama. I think 2 or 3 days before they announced their earnings. It was nicely priced for me at the time. And I entered a new position in Legal & General Group. It hit my price of 220. Is it pence or I don't remember exactly. Yeah.
Yeah, it's pence, yeah.
Yeah, exactly. 220 pence. It was already long outstanding for 2 or 3 months. And yeah, so again, another insurance company here. So yeah, and these were my buys, not too many, I would say. So I'm talking here about 7 buys that I made over the last 3 months, but they were of large value, so a little bit above what I usually pay for an individual share. Because I had a lot of conviction around Johnson & Johnson and also NN Group and also I said TROW price. So if you look at it from that point of view, my portfolio value grew by 11% year over year, but it was 4.5% organically if you take out the additional cash that I have put in. 12.2% of all the investments that I did in this quarter was reinvesting from dividends. So I'm also really happy with this. And I am now at a projected annual dividend income of approximately 49%, so which is also really nice. Keeps on growing, so I hope I'll hit the 50% soon. Should be in the next month. And my largest holding is still Shell, around 8%. Didn't really move that much. And the largest sector is still IT for me, with around 20% in my portfolio. So overall happy. Yeah, I would have loved to see a bit more dividends, but I think I clarified that also with what is the difference compared to last year.
You almost seem disappointed given this update. Come on, you're 49% to your what is it, ideal dividend income.
Yeah,
that's got to make you smile at least.
Yeah, it makes me smile, but I'm a achiever. I want to get more. I want to have more cash.
I think what it does show in this quarter is that you stuck a little bit more to conviction stocks you have more conviction in, because as you said, it doesn't look like you've done a lot of business, but it's of larger quantity, so it's not a bad thing.
Yeah.
And I think the average yield is quite high actually this quarter compared to what you usually do.
Yeah, because the insurance stocks were really attractive, so that made it really nice. But I'm all the time reminding myself, buy high quality. So that's why I have not been buying Viatris as an example at the moment. The TROW price for me is high quality. Of course, Johnson & Johnson 2 times is high quality. Defama is really high quality for me as well. Nationale Nederlanden, I would consider it good quality, and Legal & General as well as good quality. Yeah, really strong policies behind it, dividend history behind it. So this was really what I was aiming for this year. And I feel I'm sticking to the plan. I would, of course, like to buy some more high quality, maybe some Texas Instruments again, but maybe in the upcoming quarter provides an opportunity.
Yeah, I was just going to ask you, going to change anything in the next quarter? Are you going to target specific sectors? Because I know you're quite heavy in insurance here.
Yeah, I think it was the opportunity that kept on giving, right? This quarter. And these sectors, or even industries, they go in waves. So who knows? Maybe the chip industry gets hammered now because of consumer spending or something like that, or the lack of it. So maybe we get some Texas Instruments opportunities again. Is also stock that I really want to own more of.
Yeah. Cool. No, nice update. It's inspiring to see that 49%. I'm hoping you get to 50 soon. That would be quite an achievement. And then the snowball effect will really start to kick in. And
Yeah, and don't forget the dividends that will come in the next quarter, because it's the April, May, and June, all the European payers, and I've been buying quite some European stocks last year. So
yeah,
fingers crossed.
you're in for a big quarter, I think.
Yeah, exactly.
Nice one.
How about you?
I had quite a decent quarter this quarter. In March, I nearly doubled my dividend income. So it went from 180 euro, 190 euro, something like that, up to 342 euro. So it's quite a big increase year over year. My average for the quarter is just under 200 euro per month, which is not too bad. I'm currently at 12% of my FI figure in dividends. My largest holding, like you, is still Shell. It's 7.83%, mainly because of the large capital gains from that. Largest sector is consumer staples, but that is coming down. That was up around 40% at one point. It's now more manageable at 21%. And Altria is still my largest gross dividend.
Nice.
I was quite active in my purchases this quarter. So if you remember, I do have a small portion in high income stocks like CEFs that I was forced to close. So I'm closing the US based ones and investing them in some UK based ones. So you'll see companies there like ticker symbol BPCR and NCYF. So they're like ETFs, but they're not taxed like that in Ireland. So they're investment trusts. So just some of them in there. But my main boys, as you can see, is ticker symbol NN. I can't pronounce it as well as you. Vici, BTI, and Blackstone were my main ones. I did add a small bit of TROW as well. So I was quite active. Legal in general was there. I forgot I actually had an order in at them, and that's been triggered a couple of weeks ago. I didn't even know until I was viewing that. I think it was at the start of the month. So like you, I think I bought my fill of insurance companies. On the flip side, I've been selling. I sold Fresenius, had 20 shares of that. I sold Intel. I had a small bit of that, and VFC, as I think I spoke about them at the time. There's a couple of those CEFs in there as well. So overall, I have added $767 in dividend income over the quarter, which is not too bad. It brings me up quite nicely to nearly 4K. I'm nearly at the 4K mark.
Wow.
Which is quite a big jump when you consider in 2021 I was at 2K, so I'm nearly double what I was at in 2021.
Nice. And how do you feel about it?
I feel good. I did an exercise. I kind of broke all my stocks down into different allocations. I'm targeting like an 8% growth overall. That's dividend yield and dividend growth. So I split it out into dividend growth stocks, and high yield stocks, and then within the different sectors. And it's interesting that I do earn most of my dividends from US dividend growth rather than high yield, which is something that I'm happy about. But what I did notice on my European side of that, dividend growth is actually not as strong as the US. That's something I need to look at. And I think Danone and Unilever are not as strong.
They contribute to that.
Exactly, they're not as strong. But it's something that I'm looking at. You look at my turnaround stocks that I have there. They have a negative 5-year dividend growth rate. That's the likes of your Intel, your Walgreens, your AT&Ts. They're in there as well. So it was a good exercise to do, and actually highlighted some companies that I need to pay a little bit more attention to.
Yeah, I like actually your Great British Pounds dividend growth as well, although small allocation, let's say, but still good dividend growth. Is this British American Tobacco?
Yeah, British American Tobacco was one, and I think that's it. I think they're the only one.
Nice.
Because I have great British pound high yields, and that's Chesnara and Legal and General are in there now as well.
Yeah. Okay, nice.
Yeah, so overall, I think it's been a solid, like some growth,
Yeah.
good growth there. Yeah, I haven't tracked what I have reinvested like you. So in terms of what I invested and what my forward income, I think my average yield over this quarter is about 8%. But again, that's because of the high insurance companies as well. So
Yeah.
it'd be interesting. I don't think I'll be buying any more insurance next quarter, so it'll be interesting to see where the market takes us.
Yeah. So that's actually quite simple because all the cash that hits my account gets invested. Yeah, it piles up. So if you know what your dividend income was over the first quarter and you know what you have invested in total, you kind of know how much you have been reinvesting if your balance is at zero at the end of the quarter.
Yeah, sure.
Okay, good. Well, for me, these updates and also just doing it and these shows that we do around it, they are just so helpful because it really keeps me focused. So, for instance, for me now, I'm happy kind of with my buys from this quarter, but I still feel I need to do more. How you said, I still feel I need to focus more on high quality. It's not easy because high quality comes at the price. Yeah, it is what it is. It's still there. Yeah, they're just. I would love to buy 12, let's say, high quality stocks, but usually there are just 2 or 3 that are in my zone that I find it
It,
worth buying.
it's a balance, isn't it? You're trying to
Yeah.
buy the highest quality you can, but you also do look at the total return in terms of
Yeah, exactly.
dividend yield and dividend growth. And like you, what I've learned is my European dividend growth portfolio, part of my portfolio, I really need to sit down now and think about my goals and
Yeah.
what fits there, what doesn't, and see
Yeah.
how I manage that. But it's it feels like a candy store out there at the moment, and it's so hard because you're looking at it, an insurance company with an 8% yield. It's over allocated in my portfolio, and you're going, I'm buying a 2.75% yield here. I'm leaving money on the table, and that's the
Yeah.
battle.
Exactly.
Yeah.
Exactly. But that's why also what I like that you did the categorization.
Yeah.
And actually you're quite well diversified between high yields, high quality, let's say, a really nice mix.
Yeah, I was surprised, and you know what? I think there's actually some opportunities in the UK. Some Irish companies in there that I might like to own. I did a YouTube video on 3 Irish companies, so I think that might be an area I might start to pad out there a little bit as well.
Yeah. Okay. DCC
is up there, and CRH is another one.
Nice one. Nice. Good. I think it's then time to go to some of our listeners' questions, right?
Yeah, let's do it. Nakama Works as a question. Just started learning and following you, and he's learning about Ahold. He just wants to know if we have any commentary about this. I know we speak about him quite a bit, but he probably just wants a little bit of reassurance on him.
Well, he should have seen me sitting now. I'm wearing an Ahold blues at the moment here. But look, Nakama, I tell you what the bull case is and what the bear case is. I think we should always do both, right? So the bull case is it is a really, really well managed supermarket chain with its roots in the Netherlands, around 35-40% of its revenue from there. It's really an A brand supermarket there. Also really good in the high tech. Also, it owns the Dutch Amazon, bol.com. They tried to do an IPO when all the growth stocks were at their top, but they were too slow. So they still own this asset. They postponed it. At the same time, they own a lot of grocery stores, like Food Lion is a big one in the east coast of the US. It's just really, really well managed. So the bear case here is like, supermarket chains, they have really thin margins. And they have also a relatively decent debt, I would say, or capital lease. So what could happen with such a company if you would not understand the supermarket industry? Let's say you could argue like, oh, just this needs to happen and they're in trouble. The thing is with why are these companies typically having a little bit more debt is because how I said their revenue is really predictable, and during recessions they actually usually sell more. So that's why those companies can afford to have a bit more debt. Although if you benchmark it with a company like Walmart, then Walmart has a much better balance sheet. So for me, Ahold is a top-notch quality. I love it. Not at these prices. I would like to see it a little bit lower, because I'm greedy in general. But yeah, that's my story around Ahold.
Nice. Russ, our good friend Russ, has asked us, if you had to explain your investment philosophy to a child, how would you do it?
How I would do it? I did it the other day to my child a little bit. I tried to explain my son the power of compound interest, and I wanted to let him know that how much the iPhone that he wanted to have at that price at the time, let's say €1,000, how much that €1,000, if it would have been invested in Johnson Johnson, how much it would give him when he would be retired. And he fell almost off the chair from it. So he decided after that to buy a Samsung for a fourth of the price.
Nice. At least it was
But
a good
father kept
lesson.
the difference.
Sounds like a win-win.
Exactly.
I would do it by explaining about cash flow. Then if you want companies to pay you a dividend, they need to be able to afford it. Just follow the cash. And explain that to a child by giving them €5, taking that €5 off him, and then ask him for more money. He won't be able to give it to me. So say you want people who have money left over to give to you. But yeah, I think that's the easiest way, is just to explain with cash.
Yeah,
Follow the cash.
and then they complain that all our kids are not in a good shape right now, right? Those teenagers, depressions, all these kinds of stuff, because they have these kinds of parents.
I mean, my kids seem fine, right? They play football, they love having fun, and they have pretty much everything they want, but they have to either earn it, or they have to work for it in some way or shape or form. There's no such thing as a free lunch. That's what they say over here.
Exactly. You should work hard. Good. What tools or websites or data providers do you use for screening and analysis, from Dave S?
Usually my go-to is Kyfin, because it gives a good spread of all stocks, actually, EU, UK, US. But
So you write it like KOY? FIN.
Yeah, KOYFIN, Kyfin. And then recently we came across stratosphere.io, which is free.
Yeah.
So Kyfin is obviously paid for. Stratosphere.io is free, and the other one is ROIC is it AI? I think.
Yeah,
Yeah,
something like
ROIC.ai as well. I will link to them in the show notes, but they're the three that I would use the most, I would say.
I actually use the most the investor relation websites. Actually, I use them more than the tools that you mentioned. I also use ticker.com sometimes. I really like the Quarter app. So QUATR. You can download it from the App Store. There you have all the quarterly earnings reports and everything, and also the webcasts. But actually, I usually just always go to the annual reports and the quarterly reports. Also, when you go to Stratosphere, usually they are not quick enough, because when I'm usually going into the documents is either after the earnings announcements to understand really how they have done for my holdings. But if I'm really researching, I usually also, of course, I look maybe at Stratosphere a little bit at the data, but then I really still look at the balance sheet in the 10Q as an example.
Yeah, of course. But if you're screening, I think Dave said if you're screening for analysis, going into the investor relations of 100 companies, say if you're screening, is probably
no, not for screening.
Yeah.
Right.
So I think that was the question more so for screening. Obviously, for the data, I don't trust I found enough discrepancies in all of them
Yeah.
not to trust
Yeah.
them 100%. But for screening, 100%, I would
Yeah.
use those others.
Yeah.
Dividend XE. What is your opinion regarding AO Smith, ticker symbol AOS? AO Smith, if I remember, is an American water heater. They make commercial and residential water heaters. Not just water heaters, but I think that's the main business. And I remember doing an analysis on them when I first, maybe around 2019, I believe, when I first looked into them. A really, really, really good company. Solid dividend growth history, solid cash flows, really predictable, good management. But I always remember them being quite heavily priced. There was a period of time, I think during COVID, when they dropped, and that was the time I kind of wish I bought them. But their dividend yield at the moment is around 1.6%, if I'm looking at it correctly, which is way too way too low for my liking. But in terms of balance sheet, revenue growth, cash flow growth, it ticks all my boxes. It's just the valuation with this company is the key. And it's too richly priced for me, but really, really good company. Very low debt on the balance sheet, and ticks all my boxes.
Nice.
If it gets down to a 3% yield, I would snap these guys up.
Yeah. So that means almost half the price.
Yes.
Good.
Yes.
Then Jason Hurley is asking what our thoughts are on holding around 40 to 50 long-term company stocks to minimize the effect any one company can have on your dividends. Well, actually, this is exactly what I'm doing, Jason. If you go to the blog EuropeanDGI.com, you will find there an article called Portfolio Allocation Strategy. Just look in the menu. You will on the left side, you will see it there. And that's what I do. I cluster my stocks into tier 1, tier 2, tier 3, tier 4. And if you are a tier 1 company, you're maximum 4% of my portfolio. If the company will go bankrupt, I would lose 4% of value there. To be fair, I have some companies like Shell, what I mentioned earlier in the show, it's now 8% as a holding because I'm still in the accumulation phase. So Shell would have a higher impact if it will go bankrupt. If Shell will go bankrupt, though, I think we have some other problems in this world as well.
Yeah. I read that first. I said 40 to 50, that's a lot of companies. And then I quickly checked and I own 45. So I mean, we kind of already do that. And you can go the other way. You can go well beyond that. We do have a good friend within the Dividend Talk group, Alan, who has hundreds. He's like a global ETF, where really one company cutting their dividend will have virtually no impact on your overall dividends because there has so many. So I think that's what most people do. It's normally between 20, 30, and 40 stocks, isn't it, that people own? So.
Yeah.
Phil has asked for your thoughts on BABA, which I think you gave. You're quite happy with it.
Yeah.
And Prabhu has asked us, European DJI always mentions that you spread your bonus across 12 months, so he spreads the risk. What about a newcomer to dividend investing and say he has 50K cash at hand? How do they, as a European resident, go about it? Invest in ETFs or slowly move to dividend stocks?
Oh, yeah, this is difficult because let's assume here that it's really a newcomer, so doesn't really have experience with, just stock picking, analyzing what high quality companies are. So I would, with that kind of knowledge, I would always go for an ETF because an ETF, you don't really need to have the knowledge. You're not stock picking. You just need to figure out what ETF to take. If you're in Europe, it means like there are a few ETFs, and I think it's like a bet on the economy or something like that. If you're taking, let's say, a British dividend ETF, or you take just the all world dividend ETF, what I only would recommend is always at least read a bit the policy to understand like what do you pay in commission in the TER percentage there, and what has been their performance. And what are the top 10 holdings. At least this a little bit I think people should do. If they figure out like, hey, these top 10 holdings, those are companies I kind of feel familiar with, then that's good. And then I will probably take all the cash in it when I'm a newcomer. And then like, let's say the whole 50K, And from there, I would probably say to the newcomer, buy a lot of books. Yeah, we have mentioned often on the show here about Warren Buffett, how to read a balance sheet. Start with it, and then start allocating some of your monthly income into picking individual stocks. Because a newcomer, totally new, without any knowledge about this, I think I would not recommend straight away going stock picking unless you, and specifically with this amount, right? Assuming that this is for the person like the life savings.
Yeah. I mean, look, it's always circumstantial, and advising whether someone should invest in ETFs or dividend stocks is not something we can generally do. Like we talk dividend stocks, this is dividend talk. So obviously our bias is more towards dividend stocks, but ETFs have their advantages, particularly for newcomers. And stock picking is not easy. I mean, sometimes you can get that impression that it is, and there was over the last 10 years, it probably was. You throw a dart at a stock and it more than likely rose in price, but certainly we're coming into a period where it's going to require a little bit more time, due diligence, thought. How can they handle inflation? How can they handle it rising costs? What are they doing with their workforce? There's a whole lot to picking individual stocks. So I would say if you're a brand newcomer and you don't have the time, I would lean towards ETFs more so. Snowblind has asked us, what are the advantages or disadvantages of products like JEPI? They are fashionable, and I think it's an interesting topic on how they work.
So first of all, they're not accessible to us as Europeans, but let's assume they were. The benefit here, I would say, is that you get a high yield on the ETF, but don't be mistaken, this is not out of dividends. This is out of cash secured. I said no. Yeah. Call option selling. Yeah. Option trading. So I don't like these kinds of ETFs. I've been pondering sometimes with my thoughts there, like, okay, what if I would just buy some at a 10 or 11% yield, because this is what it is. But you have not really, your principles not really protected with this one, and you're really doing it purely for the high income. Now, you could take this one, YEPI, GPI, and compare it maybe with Omega Healthcare's investors. Maybe YEPI would then be a good alternative, because I spoke last week about that I don't feel so comfortable, let's say, with Omega Healthcare investors. But generally, I'm not a fan of these kinds of things. These are not dividend ETFs. Yeah, they give a high yield, but this is from option income, and this is not from dividends. And I rather prefer dividend ETFs.
Yeah, you still have to understand how options work, I think, to comfortably own these. I mean, you mentioned that you do have calls, you have puts, you have cash secured puts, you have covered calls, and they do two different things. And if I mean, I don't pay too much attention to these because, as you said, they're not accessible to us as Europeans. But say, for example, these guys sell covered calls. That limits their upside because they're selling. They're always getting sold off. So you do have to understand what options are and understand what the underlying is doing to achieve the yields that it is giving you, and how sustainable that is in a bear market, in a bull market, in all those different scenarios. There is also no such thing as a free lunch. They have a high yield, but it's a high yield for a reason. There is risk associated with that. I do not mind having high risk and high yield, but it's a small portion of my portfolio. I don't have JEPI, but I do have high income stocks and funds. But I would just say understand what they do. I can understand the appeal to them, but look, most people are attracted to the yield, and I don't think they do enough due diligence and understand the whole business model behind these companies. That's my biggest fear with these options trading. Like a lot of things was being tossed around the internet for a long time, and I got caught up in that. I'm the first one to admit it. So just be careful. Next question is from Tim, and he says, do you have any tips or tricks to avoid being price anchored?
Yes, as such, yes. Don't focus on the stock price, but focus on your fair value price. That's what I've been doing over the last year, because price anchoring is really, really hard as a psychology, really, really hard. But I just mentioned that I bought Johnson Johnson 2 times in the first quarter. My initial price was $115, or $100, then $115. It has been compounding over the years. And now I'm always looking at, okay, I want this when it's between 2.75 or 3% yield. So I bought some at 162 when it was, let's say, 2.8. And then I put my next buy at 3% here. So what I'm trying to say is, like, if you move away from the stock price as being price anchored, but rather being price anchored on the fair value, at least it's making it a bit easier for me. But still, it's one of the most toughest psychological topics in my whole dividend growth investing.
Yeah, it is quite difficult, and you see that the exercise I completed earlier when I'm looking at the yield and dividend growth and looking at the total return, and by focusing on that, if I'm getting a good yield, good dividend growth, and it's meeting my expectations, I forget about the price, and
Yeah.
that's what I'm trying to do. That's what I'm trying to incorporate. But Tim, if it was as easy as I'm saying, I wouldn't
Yeah.
have the problem, and I still do sometimes. So
You should be almost autistic, yeah, to only focus on the formula almost. Sometimes that's, I think, the best to have no emotion at all, and yeah, that's
yeah,
so tough.
we're not robots, so it's
No.
going. I think it's going to happen, but I suppose the key is trying to learn from it and write down all those times where you refused to buy it because it was too high. Come back in 3 months and see what the share price is. Has it gone up? Has it gone down? Were you right? Were you wrong? And then you might start to see some patterns maybe.
Good. I still wanted to leave the show a little bit with a stock pick this week that I'm considering as a first buy in April. And I mentioned the ticker already today. It's TROW price. I'm waiting a little bit for their message about assets under management, if there are no surprises there, because it felt like it was stabilizing now in the first 2 months. Then I will probably buy some again. Still pristine balance sheet. And what I also liked is that they, so ticker symbol TROW, they just bought a company, Retiree Inc., a fintech firm that offers innovative retirement income planning software. And we've been talking the other time about, like, this is maybe more a traditional firm, right? And their strategy is really to start picking up by also having the ETFs and such, really to go into this business, also considering fintech. So you can see at least they are really taking, putting the money where their mouth is. And that's what I like from what I saw here. And also, if you think about it, I still have this fair value around $145. So for me, it's heavily undervalued, around $113 at the moment. It gives, I believe, a 4.25% dividend yield now, something like that, 36 years of dividend growth. So for me, it is really, really nice. A really, really nice topic for me, stock for me to consider more, credit rating of A+. So yeah, just wanted to give a heads up to people that I might buy this if the assets under management don't disappoint me.
I actually thought that these would suffer a little bit more with the whole financial news and all that, but they're still holding up quite well. I've added a small bit to them in January or February, can't remember. But I'm waiting for them to drop a little bit more. But I mean, their balance sheet is what's really attractive here, isn't it?
Yes, and the yield as well. I think a 4.25% for such a high quality business, right? As well.
Yeah.
So
Yeah.
I'm not price anchored on this one. So I feel like I can buy it at this price. I can buy lower. I can also buy it a bit higher. So just once I've got the cash on my account again, I will buy some again.
Cool.
That's my thinking. Unless no surprises with assets under management, because that's the main thing I track here, because that defines a lot about what the earnings per share will be. And of course, I'm in it for the long term, so I don't think there will be any issue. But if I see that the assets under management really drop, I at least need to check my fees a bit.
Yeah. I don't think so. I don't think it will drop too much. I've just checked, and they are my fourth highest company. Actually, they've moved up quite.
Wow.
So I bought a good bit of them towards the end of last year, but I'm really hoping they drop a bit more because I would like to own a small bit more.
For me, they are number 13 or 14, so I still have some space.
Some room to go. Good. Nice to have a stock pick. We haven't had one in quite a while. I might try the next week actually. Perfect. So thanks to all our listeners for all the questions again. We hope you enjoyed the show, and we will talk to you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.